Cryptocurrency, the enigmatic digital asset, has entered 2024 with a surge of excitement. But is it a gold mine or a potential pitfall? Let's explore the answer, because here in this video, we are going to discuss why should you invest in cryptocurrency in 2024. Before we begin, make sure to subscribe to our channel and press the bell icon to get regular updates. Let's get started. There's no doubt that Bitcoin is back, whether you like it or not. Bitcoin finally hit a new high point on March 5, hitting $69,191.95. This came after a crypto winter of scams, bankruptcies, and a price drop of almost 77%. And for a short time, it went above $70,000 for the first time. This has made other cryptocurrencies more valuable, like Ether and even Dogecoin. But for people who are just interested in crypto and may not have paid attention to past highs and lows, the question is whether now is the right time to get in. Here are the main reasons why you should put your money into cryptocurrency in 2024. Number 4. New developments. Since January 10, when the Securities and Exchange Commission approved spot exchange-traded funds, ETFs, prices have gone up a lot. This is because big names like BlackRock, Invesco, and Fidelity can now sell them to customers. Also, some advisors are sounding a little more upbeat as individual buyers think about whether or not to include cryptocurrencies in their investing plans. Douglas Boneparth, head of Bonafide Wealth in New York, thinks that the market is more confident now that institutions are investing in spot ETFs. These are meant to track the price of Bitcoin without requiring individual investors to hold the token themselves. Number 3. Shifting landscape. Because crypto is risky and changes a lot of mainstream financial advisors, portfolio managers, and investment experts have quickly written it off. That seems to be changing, if only a little. Many people don't think their clients should blindly follow a diamond hands plan, but money managers have seen everyone from average investors to Wall Street pros make millions on Bitcoin by now. Some do believe that Bitcoin could be a part of the normal investor's portfolio if it is used in the right way. People trade it in a competitive market because they see value in it for some reason. We need to respect that, said Peter Mladina, Executive Director of Portfolio Research for Northern Trust Wealth Management. Number 2. Maximum allocations. A financial planner at Paramount Financial Partners in Scituate, Massachusetts, named Joseph Bowman, said that Bitcoin can make up to 5% of his customers' portfolios. Fear of missing out, FOMO, is becoming more common in today's market, which worries the man because it might make buyers buy just because prices are high instead of planning to. When people put away as much as 5%, he's seen them do well and also really badly. His goal is to know what to expect from Bitcoin's instability before he starts. The Morningstar study found that adding 2% Bitcoin to a made-up costless 60/40 its portfolio changed its return profile almost as much as adding 10% stocks. When 5% was added, the risk profile became more like that of a portfolio with 90% stocks and 10% bonds. Brian Armour, head of passive strategies research for North America at Morningstar, said that this is important because investors who are just playing around with some Bitcoin may end up making their portfolios more volatile than they planned. It can be good when prices are volatile, but it can be painful for people who need to take money out when prices are low. Number 1. Meme warning. Today's peak has also brought back things that were popular during previous rises, like meme coins and NFTs. Some coins, like Dogecoin, that people are more likely to speculate on have been doing better than Bitcoin. At the same time, the non-fungible token business is trying to make a comeback with the latest price rise. They were thought to be dead after their big crash. Experts are not sure. They say that many of the trendy assets of today aren't useful for anything other than gambling. ARM said, "We've been through this before. I want to remind people that they can gamble if they want to." Investing principles to keep in mind. These ideas may not be new to investors with a lot of experience, but they are still valid for investing in cryptocurrencies in 2024, just as they are for investing in any other type of investment. Before you buy crypto in 2024, try to remember these rules. Number 4. Never invest what you can't afford to lose. When you start buying for the first time, it can be very exciting and even cause some people to become hooked. This is especially likely to happen if you make your first purchases during a bull run when prices are going up very quickly. You may believe that things will always be that way, which can cause you to risk too much with your money and time. Investors with a lot of experience know that every investment comes with some danger. That means you should be very careful when dealing with cryptocurrencies. Start with small amounts and slowly add more money to your account. The smart thing to do is to start small and add to your crypto portfolio slowly over time. Number 3. Invest in alignment with your interests and values. From stocks to real estate to, of course, cryptocurrencies, there are a lot of different ways to put your money to work. Some people never think about dealing in real estate, and others try to stay away from stocks in certain groups, like those that are owned by tobacco or energy companies. Still, some people will probably stay away from cryptocurrencies no matter how big the market gets. People should only put their money into things that are in line with their views, values, and interests. You should invest in cryptocurrencies if you think they will change the way money works, or if you think blockchain will change many different kinds of technologies. It might be best to stay away from cryptocurrencies and blockchain technology if you have doubts about their value and usefulness. Instead, you should focus on investments that are more in line with your values. Number 2. Follow a core satellite strategy. Diversification is a key to investing, but to meet your investing goals, you should have a focus on your portfolio. This is accomplished by using a core investment and a group of smaller satellite investments. Your cryptocurrency investments will likely be a satellite to your overall investing strategy, but within that, you can also have a core to your crypto investments, surrounded by satellite tokens or coins. The majority of your capital is allocated to the core. For your crypto portfolio, you will want to choose one of the top 10 cryptocurrencies as the core. These are proven, and while still volatile, they will be more stable than new projects. You might choose Bitcoin, Ethereum, or something like Ripple as your core. Number 1. Maintain a healthy crypto portfolio. To keep your portfolio healthy, you should make your main investment and make sure you diversify by adding several smaller assets. This helps even out your returns because the picks that win cancel out the picks that lose. Adding cryptocurrencies to your portfolio as a whole will diversify it, and the crypto part will do the same. By adding more cryptocurrencies, you lower your risk and make your money invested in a wider range of assets. When you diversify your crypto investments in this way, you'll almost certainly have some winners. However, it's better to lose some while winning some than to lose everything because you put all your money into one coin. You might not make as much money as if you bet on a single coin that goes through the roof, but you also won't lose everything if the coin you pick crashes and burns. That's all for today's video. If you enjoyed this video, leave it a thumbs up and let me know what other topics you'd like to see covered in the comments below. Don't forget to subscribe for more. Thanks for watching. Have a wonderful day.